Hey everyone, welcome back to the show. Today, we're going to do a deep dive into one of those influential investing books ever written.
Absolutely.
We're talking about The
Yeah.
Intelligent Investor
By Benjamin Graham.
by Benjamin Graham. And you know what's crazy is that this book was written back in 1949.
It's amazing how relevant it still is today.
Like, I can't believe that this book could be so old and still have so much.
Yeah. The principles are endless.
Really relevant to today. And so many people say that, like, this is like the book that you should read if you want to learn how to invest.
Yeah.
And that's one of the reasons I know you're interested in checking this book out. We are actually going to be
I think it's a great foundation for anyone who's interested in investing in the stock market.
Absolutely. And we're going to be using Ben Hedges' YouTube series that he made on this book.
Yeah. He does a great job of breaking down some of the complex concepts.
Totally.
Yeah.
Because, I mean, this book is, it's not a light read.
It's pretty dense.
It's definitely not a beach read.
Right.
It's more of a textbook style.
Totally.
Right.
So having a guide like Ben Hedges is super helpful. And in this deep dive, we're going to be exploring some of the really fascinating takeaways from the book. We're going to be talking about why Graham was so skeptical of mutual funds, even back in his day.
Well, especially back in his day.
Okay.
It's funny how that's changed.
Right.
Yeah.
And even today, like, it's so interesting to think about why he would be skeptical of that. We'll also be exploring the difference between what he calls the defensive investor and the entrepreneurial investor, which I think is really relevant to a lot of different types of people with different lifestyles.
Yeah, it's all about understanding your risk tolerance.
Right.
And how much time you want to dedicate to managing your investments. Exactly. And then we'll be discussing this really fascinating 7-5-25 asset allocation strategy that he recommends. But then we're going to be talking about how does that actually apply in today's market? Because, you know, things have changed quite a bit since 1949.
Yeah, the market landscape is completely different now.
Yeah, totally. So
we'll definitely be...
Should we jump in?
We'll definitely be delving into that.
Yeah, let's jump into it. So I think one of the first things that we should talk about is, like, what is value investing? Like, what does that actually mean?
Yeah, that's a great starting point because it's really the foundation of Graham's whole philosophy.
Right.
Value investing is all about buying assets for less than they're actually worth.
Okay, so this reminds me of, like, you know, like going to a thrift store.
Yes, exactly.
Or an antique shop. And you're like, oh my God, I just found this amazing thing. And it's only like $5.
Yeah, finding those hidden gems that the market has overlooked.
Exactly. And you're like, wait a second. This is actually worth way more than $5.
It's all about identifying those discrepancies between price and value.
Right.
And Graham believed that those opportunities exist all the time in the stock market.
So that's like the essence of value investing.
Yeah.
You're not just looking at, like, what the price tag is.
Yeah.
You're looking at, like, what is the intrinsic value.
You're looking at the underlying business.
Right.
You're looking at the assets, the earnings, the management team.
Right.
And you're trying to determine what that business is actually worth.
And it sounds like a lot of this is like being a detective.
Yeah, it's very much a research-driven approach.
Right.
It's not about following the herd or chasing the latest trends.
You're like really digging deep.
It's about doing your homework and understanding what you're buying.
Yeah, totally. And you're looking for those clues that other people might have missed.
Exactly. You're looking for those companies that the market has mispriced, either because of short-term news or just because they're not as popular or well-known.
And then you're like swooping in and being like, I'm going to get this bargain.
And that's where the potential for profit comes in.
Right. Totally. So now we're like kind of getting into the mindset of a value investor.
Yeah.
And how does this differ from, like, just speculating?
Well, that's a key distinction that Graham makes in the book.
Right.
He says that...
A lot of people throw those terms around, like, interchangeably.
Right. People often confuse the two, but they're actually very different.
Yeah. So
For Graham, investing is all about...
What's the key difference?
It's about owning a piece of a business and benefiting from its long-term growth and earnings.
So you're not just like buying a stock and hoping it goes up.
Yeah. You're not just betting on price movements.
Right.
You're actually buying a share of ownership in a company.
And so it's like you're part owner of this business.
And your returns are tied to the success of that business.
Right. Totally.
Speculation, on the other hand, is more about betting on short-term price fluctuations.
So it's like more...
It's more about timing the market, trying to predict which way the price is going to move.
Yeah.
And it often involves a higher degree of risk.
Like less research and more just like gut feeling.
Yeah. And Graham was very much against speculation.
Dang it.
He believed that it was a form of gambling.
So he's like, Be an investor,
Yeah.
not a gambler.
Be an owner,
Yeah.
not a gambler.
Yeah, that makes a lot of sense. And this actually reminds me of this quote that he has in the book,
Yeah, he has some great quotes.
where he says,
They're very memorable.
an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return.
Mm-hmm.
Operations not meeting these requirements are speculative.
That's a great way of summing it up.
Right. So it's like, if you're just kind of like throwing money at something and hoping for the best.
Yeah, if you haven't done your research, if you
Yeah.
don't understand the business,
Right.
then it's speculation.
Speculating.
It's not investing.
Right. And it's so funny because I think so many people get into investing and they think like, oh, I'm just going to like try to time the market and like get lucky.
Right. It's easy to get caught up in the excitement and the hype.
Totally.
But Graham's approach is much more grounded and disciplined.
And I think especially for people who are like new to investing,
Yeah.
it's like tempting to think that,
It's important to have a solid foundation.
yeah,
Understand the basics before you start.
totally. And to understand that like, okay, this is a long game.
Mm-hmm.
This is not like a get rich quick scheme.
It's a marathon, not a sprint.
Totally. And it's about like really being strategic and thoughtful.
Exactly. And Graham provides a framework for doing that.
Yeah. So, I mean, this is already like super helpful. Just kind of like setting the stage of like what value investing actually is.
Mm-hmm.
Now, you mentioned earlier that Graham was like surprisingly skeptical of mutual funds.
Yeah, that was one of the things that surprised me the most when I first read the book.
Even back then.
Yeah, even back in the 1940s.
Right.
He was already questioning the conventional wisdom about mutual funds.
Like everyone was like, oh, mutual funds are the way to go.
Yeah, they were seen as the safe and easy way to invest in the stock market.
And he was like, I don't know about that.
Yeah, he wasn't convinced.
So why was he so skeptical of them?
Well, he had a few main reasons.
Okay.
One was fees. He felt that the fees charged by mutual funds were often too high.
So he was like, you're losing money right off the bat.
Yeah, he felt that those fees were eating into investors' returns.
Yeah, that makes sense.
He also questioned the performance of mutual funds.
So he was like, are they even doing a good job?
Yeah, he argued that many mutual fund managers failed to consistently beat the market.
Oh, interesting. So he was already like kind of hinting at this idea of like, is it skill or is it luck?
Right. He was very skeptical of the claims made by many fund managers
Yeah.
who often touted their expertise and their ability to pick winning stocks.
Right.
But Graham believed that much of their performance was due to luck.
Totally. And so he's like, why am I paying these high fees if I'm just like getting lucky?
Exactly.
Yeah.
And he also emphasized the importance of control. He felt that investors should have more control over their investments.
So he's like, you should understand what you own.
Yeah. He didn't like the idea of handing over your money to someone else.
Right.
And not knowing exactly what they were doing with it.
Yeah, because with a mutual fund, it's like you're just buying into this basket of stocks.
Right. You're not making the individual stock selections yourself.
Right. And you might not even agree with all of those stocks.
Exactly.
You're kind of just like trusting this fund manager.
And you're at the mercy of their decisions.
And so Graham was like, I don't really love that.
Yeah. He believed that investors should be more engaged and informed.
Right. So he's like, take control of your own destiny.
Yeah, be an active participant in your financial future.
Yeah, totally. And this is so interesting because, even today, this is a debate that people have.
Yeah. The active versus passive investing debate.
Right.
It's still raging on.
Yeah,
And Graham was definitely on the side of being more active and involved.
right. I think a lot of people today are like, oh, index funds are the way to go because they're low cost.
Yeah. And they're a great option for many investors.
Totally.
Yeah.
But it's like there's still that element of like, do I want to actually be picking the stocks myself?
Right. And that's a personal decision.
Yeah.
There's no right or wrong answer.
Totally.
It's funny, we were just talking about mutual funds and Graham's skepticism of them.
Right.
And it kind of ties into this idea that he really believed in the power of individual investors.
Right. Like you don't need to rely on these fancy fund managers.
Exactly. He felt that individuals armed with the right knowledge and approach
Yeah.
could actually achieve great results in the market.
So it's kind of like that DIY ethos.
Yeah, take control of your own financial destiny.
Right. And don't just like blindly trust these experts who might not actually have your best interests at heart.
Exactly. And he even goes so far as to say that in many cases, picking stocks successfully is more about luck than skill.
Wow. That's a bold statement.
It is, but he makes a compelling argument.
So he's saying that even the pros.
Yeah, even the professionals with all their resources and research,
Right.
they can't consistently predict the market.
So it's kind of like there's this element of chance.
Yeah, there's always going to be an element of uncertainty.
Right.
And Graham believed that trying to outsmart the market was a fool's errand.
So it's like you're not going to be able to time the market perfectly.
Nobody can.
And like pick all the winners.
Right. And that's why his approach is all about minimizing risk
Okay.
by focusing on the underlying value of the businesses you invest in.
So it's like creating that margin of safety that we were talking about earlier.
Exactly. It's about buying stocks that are trading at a discount to their intrinsic value.
So even if the market takes a downturn,
Yeah.
you're protected.
You're less likely to lose money.
Right. So it's like that buffer zone.
Yeah, like having a cushion.
Yeah. That's a great way to think about it.
Yeah.
Now, how does Graham actually suggest that individual investors go about picking stocks?
Well, he provides a very systematic framework for analyzing a company's financial health.
Okay, so we're going to put on our detective hats again.
Yes, exactly. We're going to delve into the financial statements.
Okay.
We're going to look at things like earnings assets, debt, cash flow.
So we're not just looking at like the stock price and like what the analysts are saying.
No, we're going beyond the hype.
Right.
We're looking at the fundamentals.
So it's like getting under the hood of the car.
Or kicking the tires.
Right, and being like, okay, what is actually going on here?
We're making sure the engine is running smoothly.
Right. Now, this sounds like a lot of work.
It can be.
Like, how much time do you realistically need to spend on this?
Well, it depends on how much you want to invest and how comfortable you are with financial analysis.
Okay.
But the key is to start somewhere.
Right.
Even if it's just picking one or two companies to research thoroughly,
Okay.
you can gradually build your knowledge and confidence over time.
Now, one thing that I've always struggled with is like, how do you actually translate all those numbers into an actual decision?
Right.
Like, is there some kind of formula?
Well, Graham didn't believe in magic formulas or shortcuts.
Okay.
He was all about making informed decisions
Right.
based on careful analysis.
But like, how do you know?
And a key part of that is determining a company's intrinsic value.
There's that term again.
Yes. It's a crucial concept.
So how do you actually determine that?
Well, it's not an exact science,
Okay.
but Graham provided a framework for estimating it
Okay.
based on a company's financial performance assets and future prospects.
So it's like trying to look into the future a little bit.
In a way,
Yes.
you're trying to project how the business will perform in the years to come.
Right. And this is where it gets a little bit fuzzy for me, because it's like, how can you actually predict the future?
You can't predict it with certainty,
Right.
but you can make educated guesses
Okay.
based on the information you have.
So it's like using the clues
Yeah.
to like piece together a story.
Exactly. And that's what financial analysis is all about.
And then you're like, okay, based on this story,
Right.
I think this company is going to be worth this much in 5 years.
And if the current stock price is significantly lower than that estimated intrinsic value,
Right.
then that's a potential buying opportunity.
Okay. So you're looking for that gap between
Yeah.
the current price and what you think it's going to be worth.
Exactly. And that gap provides your margin of safety.
Now, all this talk about intrinsic value and financial analysis,
Yeah.
it reminds me of something that Hedges mentioned in his videos about how
Mm-hmm.
Graham's book can be a little bit dense and challenging to read.
Yeah, it's definitely not a light read.
Right.
It's very detailed and thorough.
So for someone who's like new to investing,
Yeah.
it could be a little bit overwhelming.
It can be, but that's also part of its value.
Okay.
It's a book that you can revisit multiple times,
Right.
and you'll likely glean new insights each time you read it.
So it's like one of those books that you keep on your shelf
Yeah.
and you're like, okay, I'm going to refer back to this.
It's a timeless classic.
Right. Totally. Now, you mentioned earlier that
Yeah.
there are updated editions of the book available.
Yes. And those are actually very helpful
Okay.
because they provide commentary and context
Right.
that helps bridge the gap between Graham's time
Mm-hmm.
and ours.
Because the world has changed so much since 1949.
The market is completely different now.
Right.
So it's helpful to have those modern perspectives.
So even though the book might seem a little bit daunting,
Yeah,
it's still worth the effort.
absolutely. The insights are invaluable. It's a foundational text for anyone who's serious about investing.
Awesome. Well, I'm convinced. I'm going to check it out. So before we wrap up,
Yeah.
let's kind of summarize what we've talked about today and where do we go from here? Wow. I mean, this has been quite a deep dive into the intelligent investor.
Yeah. It's a lot to process.
It really is.
Yeah.
But I feel like we've covered so much ground.
Mm-hmm.
And it's amazing how relevant Graham's ideas are.
Yeah, his principles are timeless.
Even though the book is over 70 years old.
It's incredible how much the market has changed.
Right.
But the fundamentals of investing remain the same.
Totally. And I think that's like one of the biggest takeaways
Mm-hmm.
from this deep dive is that it's not about like trying to time the market
Right,
or like
right.
kick the next hot stock.
It's about being a disciplined and informed investor.
Right. It's about like understanding the businesses that you're investing in
Exactly, and making rational decisions.
and not getting caught up in the hype.
Yeah, avoiding those emotional traps that can lead to bad decisions.
Totally. No. One thing that I'm still kind of grappling with is like,
Mm-hmm.
how do Graham's ideas apply to today's world?
Right.
Where we have things like index funds and ETFs.
Yeah, those are definitely things that he didn't write about specifically.
Right, because they didn't exist back then.
But his principles can still be applied.
Okay, so it's not about like throwing out everything he said.
No, it's about adapting his framework
Right.
to the modern market.
So for example, when you're choosing an index fund,
Yeah.
you can still look at the fees.
Absolutely. Low fees are always important.
Right. And you can look at the underlying holdings.
Mm-hmm. You want to understand what you're actually investing in.
Right.
Make sure it aligns with your investment goals.
And you can also consider the long-term growth potential.
Yeah, you're still looking for value,
Right.
even in a passive investment like an index fund.
So it's like those principles are still relevant.
They are. They're timeless.
Yeah. And I think that's really empowering
Mm-hmm.
because it means that we can take control of our own financial destinies.
Exactly. You don't have to be a Wall Street expert
Right.
to be a successful investor.
You just need to have the right knowledge.
Yeah, and the right mindset.
And the willingness to put in the work.
Exactly. And Graham provides a roadmap for doing that.
Yeah. So, I mean, even though The Intelligent Investor can be a bit of a challenging read,
Mm-hmm.
I think it's a really valuable investment.
It is. It's
Yeah.
an investment in your financial education.
Right. And I think that's something that everyone should consider.
Absolutely.
Whether you're just starting out or you've been investing for years.
It's never too late to learn.
Totally. And I think, one of the things that I'm taking away from this deep dive is that it's really important to be an active participant
Yeah.
in your financial journey.
Don't just blindly follow the crowd.
Right. Do your own research.
Make your own decisions.
And really think about what your goals are.
Exactly.
Yeah.
And what level of risk you're comfortable with.
Totally. So as we wrap up this episode,
Mm-hmm.
I want to leave our listeners with a question.
Okay.
If you could ask Benjamin Graham
Mm-hmm.
one question
Yeah.
about investing in today's world,
Oh, that's a good one.
what would it be?
That's something to think about.
Right? It
Right.
really makes you think.
Yeah, it does.
And it's a question that we can all ponder as we continue our own journeys of becoming intelligent investors.
Thanks for joining us on this deep dive.
Thanks, everyone, for listening.